welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whatever streaming platform you're listening on, and by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Andrew Jones, based out of the London office. And this week I'm joined, as always, by Richard Carter, head of fixed interest research and one of our macro brains, and also by Maurizio Carulli, who is our oil, gas and materials analyst and is probably one of the few people who isn't really feeling the heat, as this is nothing to a native Roman such as himself. Richard, I'm going to start with you. Is 7 a lucky number?
Is 7 a lucky number? Is that the number of prime ministers we've had since Brexit now, is it?
That's the number of prime ministers we've had this decade. I can't tell you whether I'm including Andy Burnham in that or not. In fact, I can't tell you whether Andy Burnham will be our next prime minister. But I had a few witticisms prepared on the basis of whether Starmer was going to resign or not, and he's somewhat spiked my guns by going and resigning about half an hour ago. We talked about this a couple of months ago, the last time I did this podcast, as to whether there was a route through, and a route through was found. Reform sort of cooperated, I think, by putting forward I thought was an extremely weak candidate in Makerfield, who duly got swept aside. And here we are with certainly with a change of leader. What are your views on this?
Well, if he's number 7 now, he's only going to be presumably in charge until the next election. So that he might have a fairly short-lived period of time unless he can really turn it around in the polls. I think it's not really a surprise what's happened today. I mean, ever since Burnham won the Makerfield election, it's obviously been clear that Starmer's going to have to step down. I think it'll be interesting to see now whether someone stands against Burnham or whether it's just going to be pretty much a coronation. I think it would be quite good to see a contested leadership election where there can be a test of ideas and where the candidates can be properly tested out, because otherwise Burnham, might face accusations that he's not had any real sort of national scrutiny, and will come straight into a pretty difficult situation when he comes into number 10.
I think that's right. I think it's very much in your ballpark as a macro and fixed income specialist, because Burnham brings a great deal of baggage, shall we say, into the fixed income space, given his past comments on borrowing and so on. And I think this is the hard constraint. The gilt market really is now the hard constraint in British politics. So I think the language is going to change, but it doesn't change the arithmetic.
No, it doesn't, and I think he faces the same problem that all his predecessors will have faced. That there's too much debt in the country, and if they try and sort of break out of this issue by sacking people from the Treasury or ignoring the fiscal rules, they will go the way of Liz Truss. So it is a very difficult one for him. He seems to be being advised by sort of fairly sensible people, including sort of Jim O'Neill, and Burnham, like a lot of sort of politicians after a particular job, has said many different things to different people which don't all necessarily align one with the other. So we'll have to wait and see what his programme is, but certainly the gilt market thinks he's going to be to the left of where Keir Starmer is. The crucial thing really is going to be who is his pick for Chancellor, and what their views are, particularly around, as I say, the fiscal rules.
I think the Chancellor is going to be a very important call. And in this sort of situation, I tend to be as interested in what the bookies say as to what political commentators say. And the bookies have Ed Miliband as 3-1 on. And that's pretty much level pegging with Pat McFadden. Now, they're quite different characters. Yvette Cooper is, I believe, the market's favourite. She's down at a straight 3-1. So the bookies don't think there's much chance of Yvette Cooper as Chancellor, and Wes Streeting as evens. Now, I think Wes Streeting is an interesting option because that could be the big job that he is given as a sop to prevent him from standing in a leadership contest. That would work, but I really am gaming it on the back of an envelope at that stage. But I think the choice of Chancellor is going to be really important because I think Burnham is going to come into this with a lot less tolerance from the markets than other candidates might have had.
I agree with that, and I think although markets would, I mean, I think gilt markets would be quite happy if Rachel Reeves remained in place. Although I don't think that's the most likely scenario. It's interesting if sort of Wes Streeting does a deal and says, "Listen, I'm not going to stand against you, but I want a top job, or to be Chancellor, for example." We've seen many times down the years, haven't we, chancellors and prime ministers not getting on, and that doesn't really help the way government works, and that's all tends to sort of leak out into the open. So I do think, whilst the market would prefer a sort of more someone like Streeting from the sort of right of the Labour Party, it is important that Burnham appoints, if he is next Prime Minister, is politically aligned with them. I think otherwise it could end up in a bit of a battle and a bit of a mess. But certainly Miliband is viewed with some sort of concern, I would say.
I would say that concern is justified. Okay, look, that is interesting. We're going to have an interesting summer because it looks like it's going to be September before we get an answer. We may or may not get a contest. But this. I don't want to drown out some other important stuff that happened last week. There were two important bits of data came out. One was a bit better than expected, which was inflation, which came out at 2.8 rather than, I think the market was expecting a 3, due to cost of living and oil prices and all the rest of it. And I understand that it was food was one of the main data points that came in below it, or was a depressor on inflation, if you like. So that is positive. But the borrowing figure came out at 23.3 versus an expectation of 18.9 billion for the month. Now these a billion here, a billion there. Pretty soon you're talking real money, and I think that was a pretty worrying figure, especially in the context of what might turn out to be an auction of promises in a leadership election over the summer.
Yeah, I mean, it just kind of shows what a difficult inheritance whoever takes over as prime minister has got, and they'll be very much aware of that. As I say, the whole Liz Truss episode is a lesson of what happens when you kind of disregard it. I mean, the country is spending a huge amount on not just the various demands of the government, but debt interest costs as well, not helped by the huge amount of inflation-linked bonds that the UK has issued. So those certainly add to the costs, and it's something that needs to be brought under control. But is someone like Burnham going to be keen on doing spending cuts on areas like welfare? I doubt it. And then you've also got the whole debate around military spending. So not good. I mean, the best kind of news, really, obviously we're going to come on to speak with Maurizio, but the fact that there seems to be some progress in the Middle East and on the oil price is good news in terms of forward-looking inflation. But we've still got rising prices to come, I think.
Absolutely. I think that's correct. Now, look, you mentioned oil prices, so I'm going to switch over to Maurizio now, if I may. There's been a lot of chatter UK politically, as Richard and I have been discussing, but there's also been a lot going on in terms of Middle East politics and whether the best deal ever in the history of deals is actually going to sort out this problem. I mean, the acid test, of course, is how much oil passes through the Straits of Hormuz. And there's a bit of an anomaly in terms of how the oil price has reacted, which I'll come on to in a second. But I just thought it would be interesting to discuss where we are right now. I looked at what was happening in the Gulf over the weekend, and as of Saturday night, the Gulf was closed. AIS, which is a system whereby ships automatically report their locations. So I'm looking live at the Straits of Hormuz right now, and when I did that late on Saturday night, the Gulf was closed, and there was one oil tanker making its way very quietly up the coast, very close into Oman. But it did have its tracker on, which is interesting because all the way through the early parts of the crisis, that seemed to have been happening, but without the trackers on. So I could see the ship. This morning, I can tell you that the Sea Ace, which is a chemical products tanker, it is a Panamanian flagged chemical products tanker, is outbound through the Gulf of Hormuz, making about 6 knots, very much on the Iranian side of the Gulf. And there are a whole number of other tracks of vessels. So I would say that without much doubt, the Strait of Hormuz is currently open. Interestingly, or at least interestingly to a geek like me, those ships are mainly on the Iranian side now, and they are ignoring the vessel traffic separation scheme, which is in the middle of the strait, which might suggest that traffic separation scheme is a little bit hot with mines, because it's where you would normally expect vessels to be. Vessels are making their way up the Strait of Hormuz at steaming speed, about 15 knots or so, and then are slowing right down to 6 knots to pass the hairpin bend in Hormuz itself. So that's the state of play at the moment, Maurizio. Do you think this is going to last, or do you think this is going to all fall apart over the coming days?
Of course, we have to see. The positive thing is that a memorandum of understanding has been ultimately signed. And in terms of passage of oil, just to put things into context, before the war started, there were about 60 vessels passing through the Strait of Hormuz each way, so overall 120. That dropped after the start of the military operation to just a low single number, and on some days zero passage, because of course the priority of ship owners is the safety of the crew, and also because the value of the vessel it depends also on its the level of insurance that he can have, and a lot of insurers were either rising very substantially the premium for the insurance, or altogether withdrawing that coverage. And so, of course, as a ship owners were reluctant to risk the entire value of the vessel without insurance. On Thursday, to be fair, there was some decent passage of vessels, nearly 20. So, I mean, a fraction of what was before, but certainly more than what we have experienced in the past few months. Then, as you very correctly said, on Saturday, the traffic dropped. The hope is that progressively the strait can reopen. There are a number of things to be solved before that. The first one is also, of course, the main route through the Strait of Hormuz is understood to have the risk of mines, and therefore that will need to be cleared. So far, the only ships that have passed are either through the very coastline of Iran or very close to the coast of Oman. But again, the traffic hasn't restarted yet properly, and so this will depend on how the political environment will be. The hope is that a deal in Switzerland on the Lake of Lucerne will be achieved, at least for some elements of what is at the moment under discussion.
Okay, no, that's good, and I think all progress on this area is very important. There's one thing I wanted to circle back to you on, which we've talked about in the past. There's been this expectation that while oil prices obviously were being elevated, correct me, but I don't think they've ever exceeded $110 a barrel in this particular crisis. But that if the problem wasn't sorted out in a fortnight or so's time, the oil price was going to go up to 150 and 200 was certainly possible. But that two or 3 week window seemed to be rolling. It always seemed to be from where we are now, another couple of weeks, and it all needs to be sorted. Another couple of weeks, and it all needs to be sorted. And what seems to have been happening in the background to all of this is that the Americans were convoying oil up the coast of Oman in smaller bunkering-sized tankers, obviously with their tracking systems all switched off, running dark, with Apache helicopters flying as escorts. This is what happened when the Apache got shot down accidentally on purpose. And then transferring those cargoes into ocean-going ships around the corner in the Gulf of Oman proper, which obviously feeds into the Indian Ocean. So it seems to be that was probably the factor that stopped oil prices from really running out of control, because the oil supply was always a little bit better than markets really thought. Is that fair? Is there?
No, it's a very good point, Andrew. And I must admit that oil analysts, including myself, have been scratching their head of why, despite such a sharp fall in supply, the oil price hasn't reached a higher level. We have started to have a bit more of data now after more than 3 months that the strait has been closed. And so I can try to make a picture, an explanation of why the oil price hasn't shot up so much. The first point is that to remember is that there were about 20 million barrels per day passing through the Strait of Hormuz, which represent roughly 20% of overall world production of oil. Now, the first thing that happened was that Saudi Arabia was able to switch a good portion of its production from the Persian Gulf, transported it via a pipeline, east-west pipeline that was built some decades ago, to the Red Sea. And so up to 5-6 million barrels per day were redirected there. And this, of course, ameliorated the pressure on oil price. Second, which is less known, China, which had accumulated a very substantial amount of strategic oil reserves and commercial inventories of both oil and oil products, stopped more or less to buy oil in the past couple of months, choosing to use reserves and strategic reserves and commercial inventories instead, because they thought that they didn't want to buy at a too high oil price. And that has been, a fall in demand, if you want, of about 4 million barrels per day. So quite significant. But again, has been achieved via utilizing inventories, i.e. a sort of short-term measure, rather than via dropping the usage of oil. A third point has been that the US has expanded dramatically in the past 2 months its exports of oil and gas by almost 5 million barrels per day, again using its own strategic reserves and its own inventories, commercial inventories, so not without producing more. And so there has been a significant portion of that 20 million barrels per day, which has been depressurized by the usage of inventories. Of course, inventories do not last forever, and therefore, if the closure of the Strait of Hormuz continues, there will be quite a significant problem. Then, last but not least, what you very correctly mentioned, there has been some sort of dark fleet passage of oil, but if we use the figures provided by the US, the That has amount to almost 100 million barrel overall during the past 3 months. This represents only 1 million per day, roughly. So a small portion of the 20 million that were used to pass through the Strait of Hormuz. So it's again an ameliorating measure, but not that significant.
Okay, that is very useful. That's very useful indeed. I just hope things calm down a little bit now, because there's clearly an awful lot of slack in the system. That not slack, it's an awful lot of moving parts that rub against each other, I think is what I mean in this particular situation. So I think the oil price will stay elevated for a while. Do you see? I mean, I'm not sure it's going to fall back to the $60 a barrel it was before. I think it'll stabilize around about where it is now for a while.
I doubt. First, because again of the constraints on supply that will continue to remain. Second, because the usage of inventories and strategic reserves has been very strong. I mean, consider that the US strategic reserves are at the lowest level since the 80s. So once the flow of oil will restart in full phase, which will take months, there will be the need for rebuilding both strategic oil reserves and commercial inventories, and therefore they continue to be demand, and that should support prices. So I don't see this year oil prices going back to $60-65 per barrel as before the war.
Okay, well, that will have an effect on the inflation figure. So perhaps things won't be quite as benign as the most recent print suggests. Before I let you gentlemen go, Maurizio, CRH, interesting company. It's been shown in we've got a fair amount of it. It's been shown in client portfolios as a UK equity, as a European equity, and now it shows up as a US equity. And it's a building materials firm, and it's about to buy a building materials firm. So is that a straightforward horizontal merger?
Yes, I mean, basically, first of all, CRH has now exclusively a full US listing, and the reason for that was because the CRH has a large presence there. Nearly slightly more than 70% of its EBITDA come from the US, and also because the US is a very large liquidity market, and therefore that was another reason. The Financial Times has this morning reported that CRH is considering acquiring a US construction materials company called Arcosa, which has about 7 billion market cap, so about a tenth of CRH size. CRH has a long successful history of bolt-on acquisition, which has created value for CRH shareholders for many years. So far, no official communication has been issued, and we do not have any details, financial details of this possible transaction. But what I would say is that the acquisition would be in line with the CRH strategy to expand further in construction products and engineered structures in the US to benefit from the substantial need for infrastructure spending there.
Okay, well, that is reasonably positive. We haven't really seen how the CRH share price has responded, obviously, with the US being well, obviously not being open yet, and obviously being closed on Friday as well. Have you seen any movement so far in at all?
No, we will need to wait to have a proper, visual of the impact on share price of this news. We will need to wait the opening of the market.
Okay, well, fingers crossed it's not taken too badly. Gentlemen, look, thank you both for those great insights, and thank you all for listening. I hope you enjoyed our discussion today. We love to hear from our listeners, so please review the show wherever you're listening, and share it on your socials, and tag us at Quilter Cheviot. To make sure you don't miss future episodes, tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overviews, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and upcoming events and webinars on our website and on our social media pages. Finally, if you have any questions you'd like to ask us for our next podcast, simply ask them via the weekly comments page on the website. We would love to hear your questions. And that's it for today. So thanks, Richard. Thanks, Maurizio. Don't die of heat stroke today. And thank you all for listening.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.